right. Thanks everyone for joining us. My name is Amanda Henry. I'm a business analyst with Coconino Small Business Development Center, SBDC. We are absolutely delighted to have LuAnn Roberts with us today, presenting on year-end tax prep. Very thankful to have professionals like her who are willing to work with us and share their knowledge because I certainly am not a tax accountant. So very, very grateful to have her with us today. For anyone who is not familiar with the Small Business Development Center, I just want to take a moment to talk about who we are and what we do. So we are a no-cost resource for small business owners. We can assist with starting a business, expanding your business, growing your business, exiting your business. So if you're interested in working with us, I'm going to pop in the chat our link so you can see, get a little more information about us and to register with us. But that is who we are. So now I'm going to hand it over to LuAnn Roberts, who is her business is Roberts Accounting Solutions. I'll let her tell you all a little bit more about her, but we absolutely love working with LuAnn. Thank you so much, LuAnn.
Well, thank you. I am very pleased to work with SBDC. They are an amazing wealth of knowledge, and for everybody on this call, you probably have friends who are self-employed as well. Let them know about the SBDC. As you know, there's wonderful free resources, and you can't beat that. So today we're going to talk about taxes, everybody's favorite. So let's kind of dive in. Specifically today, we're talking about self-employed taxes. So who's self-employed? Just want to make sure we're all on the same page. Independent contractors, freelancers, sole proprietors, entrepreneurs. We have lots of names for it, but it all just kind of comes down to individuals who work for themselves and are not an employee of someone else or of their own business. So they are someone that is going to file on their individual tax return. So I'm going to talk a lot about terminology because I feel like it's important to explain it so it's not so much of a foreign language, and also so that it kind of demystifies the whole process. Um, so Also, I'd like to say if you have questions, feel free to raise your hand or whatever, and I'll be glad to pause. Amanda will help me see that, and or you can throw something in the chat, and Amanda will kind of help redirect the conversation as needed. We'll also leave time at the end so that you can ask your questions as well. All right, so we're talking just about income tax. So here's a kind of a cute little uh, picture here that there's the business structure versus the tax return. So you might have heard of LLC, you've heard of sole proprietor, corporation, S corp. And so just to clarify, what we're talking about today is just the narrow focus of when you are self-employed, as we just defined in the last slide, is sole proprietors or single member LLCs. Both of those file what's called a Schedule C. We're going to get very intimate with what that means here in a minute. And I want to pause and also talk about, again, some other terminology. So LLC, what's an LLC? LLC means limited liability company. And you form an LLC or an Inc. or a corporation with the Arizona Corporation Commission. And that is a legal designation. It actually has nothing to do with the tax return. So you can form an LLC, but it is meant to be legal protection and not so much a tax choice. So as an example, an LLC can be taxed. So I use the analogy, LLC is you give birth to the entity at the Arizona Corporation Commission, but then at the IRS, you get to pick how that baby is taxed, or kind of like the gender of your new baby. And so it could be a sole proprietor, a partnership, an S corp, or a C corp. And so all LLCs are with one parent, if you will, with one single member, are all born as sole proprietors. And so for the most part, that's what we will be talking about. So you can get a separate EIN or Social Security number for that new baby, or you can just use your own Social Security number, and I'll demonstrate that. At Arizona, you don't actually have to do anything um, special because, again, we're talking only income tax. But you might need to enroll in Arizona to get, say, a sales tax license, which is beyond the scope of what we're talking about today. And finally, I want to remind new business owners that you might need to check in with your the city that you live near. So, for example, even if you lived in Coconino County, you would still need to get a Flagstaff business license because you do business within the city limits. So you just want to check in with your city and see if you need to do anything for them. But again, that has nothing to do with income tax, and we're just focused on the IRS for the most part here. All right, next. So, as you may know, taxes are a little confusing, but let's demystify it. So, you're all probably familiar with the 1040. That's the form number of your individual income tax return. And down here on line 8, is additional income from Schedule 1. Okay. And then there's the Schedule 1. And so that's like another cover sheet. So your 1040 is just a cover sheet, and then there's all these supplementary pages behind it. And then, so then we go to Schedule 1. And on line 3 is business income from Schedule C. And so that's what we're going to talk about today is our Schedule C business income. And we're going to get into detail about what this form means. So I definitely recommend that you use a software to file your tax return. It's far too confusing for somebody to fill it out on their own if they have a business, in my humble opinion. And you might even be using software. So I'm just going to be using examples of software. I'm not necessarily saying one is better than the other, but I personally use QuickBooks, and then I more often use TurboTax or something that is related to the TurboTax family. So with that said, why it's important for you to understand where these numbers go, kind of chase the numbers around with me, is that even if you did your bookkeeping, say in QuickBooks, which then will sync with your TurboTax, you still need to check the numbers because it might import incorrectly and you need to know what you're looking at so that you can compare and see whether it's correct or not. Okay, it's really just basic math. Um, Income minus expenses, but it's just good to understand where it all comes from. Okay, here we go. So the simple form calculation is revenue or sales or income, all those words mean the same thing, minus your expenses gives you your profit. And it is your profit that you're taxed on. It's not how much money is sitting in your checking account. It's not how much money you took out of the business in the form of draws. A lot of people are familiar with that's words of taking money out of your business account into your personal. That's not how you're taxed. You're taxed on the verifiable information of income minus expenses gives you your profit. If your expenses are bigger than your sales, then you have a loss, right? And if you have a loss, then you don't have to worry about paying any income tax whatsoever. Any questions so far? Just want to pause a sec. So far, so good? All right, awesome. Okay, so we're going to talk about the top part of the Schedule C. So with this Schedule C, remember you are still the person. And so even if you formed an LLC, the LLC is disregarded for tax purposes. So I just want to clarify that. So you'd put your name, and again, you could either just use your Social Security number, or you could apply for and get a separate EIN or employer ID number. Either one is fine. It's still ultimately going to be connected to your Social Security number. You have to put in the principal business, so whatever that may be, and then there's a code. So if you're using software, it's going to walk you through how to get this code. They just try and put you in a box. Like, are you a handyman or are you a doctor? And then the business name. So a lot of times we'll have some sort of doing business as name. The next thing is the address, which usually comes from your front page of your tax, the 1040. Accounting method, you can always just go with cash basis. And let me pause and explain that. Cash basis means the money that actually was deposited into your checking account from your customers and or the expenses that actually left. So very simple, just like your normal checkbook, money that came in or money that came out. That's your cash basis of accounting. Accrual basis includes accounts receivable or accounts payable. So as an example, if you're using, let's say, software like QuickBooks and you created a invoice, but it hasn't been paid yet on a accrual basis, that in the sale would be included, but on a cash basis, the sale isn't included until it's paid, right? So when it actually gets into your checking account. So just to again offer a little terminology, you want to be filing your tax return on a cash basis when you are a sole proprietor. Okay. Any questions about that? And then just a couple of quick questions. Did you materially participate? Did you participate like this was your main thing? Yes, you're going to answer. Did you start the business? You can check that if that's applicable. Um, did you make any payments? So 2025 tax forms are not out yet, by the way. Did you make any payments in 2024 that would require you to file a 1099? So 1099s we'll talk about here in a second, but you may receive 1099s because you provided services, and you might need to issue 1099s because others provided services to you. Anyways, the answer is if you needed to file a 1099, did you? And of course, that answer is yes, because of course you would do what the IRS wants to do. Any questions? So far, so good. All right, next slide. So we're going to just take the Schedule C in chunks. So we saw the very top part of it. Now we're going to see the next section, which is part one, talking about income. People often ask me about what income is. And so let's just pause there. And it's only what customers pay you for your products and services. So then the question is, what if you take money from your personal account and put it into the business? Is that income? No, it is not income. That's that owner draw thing. And that has nothing to do with our income or our expenses. So focusing only that revenue only is what your customers pay you. Fair enough? So you might receive a 1099. A 1099 is simply the IR or a requirement that whoever paid you, if they paid you more than $600 for services, if they paid you again more than $600 for services in a calendar year, then they're required to issue a 1099 and tattle to the IRS that you made this money with them. It's like people sometimes don't report all of their income honestly. It's like it's under the table. So, fun fact. Um, so, lawyers as an example. So we just talked about if it was $600, then it has to be a 1099. If you're a lawyer, they have to issue you a 1099 for any amount. It's I don't understand that. Anyways, just teasing. Anyways, it's true. But so you might receive a 1099. Just so you know, 1099s must be mailed out by January 31st. A lot of softwares will do that. Um, and, and the new One Big Beautiful Bill, by the way, increases that amount to $2,000, but not till next year. So for 2025, we still have the 1099 requirement that anything over $600 requires a 1099. Okay. Let me also say that you do not need a 1099 from whoever paid you to report your income honestly. Fair? You don't need to be waiting for a 1099. You need to be reporting what actually you got paid. All right. Next slide. So now we're into expenses. That is the best tax savings advice I can give is making sure that you capture all of your legitimate business expenses. And what is a legitimate business expense? It's anything that goes into the production of your income. And so that's different for every business owner. And so in part two, there's a lot of generic um, expense categories. And just to kind of expand our words a little bit. So these income and expenses, this is your chart of accounts if you're using software. That's your account listing. And those are your categories. So just use lots of different words. They're all synonyms. Um, so that you have, when you have a transaction, then you record it to a category. Even if you're using a spreadsheet, you need to be doing that because ultimately what we need for the tax return is to know how much did you spend in advertising last year? How much did you spend in insurance last year? So you've got to gather up the totals, and that's what software is so wonderful for, is it makes it easy for you to have this information at your fingertips. And then you have the opportunity to add as many other expenses outside of these categories that may be unique to your business. So if you're a dog groomer, you can deduct dog biscuits. If you're an accountant, probably can't. So that's a common question of what can I deduct on my business? And again, that's the most important thing. Amanda, let's take it off of mute or something for a sec. People usually have a lot of questions about that, and so I want to entertain a few of those. Any questions about what your business expenses might be?
Feel free to throw it in the chat too, or just to unmute yourself if you do have questions.
Would things like a meeting at a restaurant be included? If you were
Yes.
okay.
Yeah, great question. So if you're meeting with a client, then that is a deductible meal. That's one of the things on line 24. So a meal is only 50% deductible. I guess the IRS thought you had to eat anyways, but you put the full amount on your tax return or in your tax software because the software will deduct it and make it look like 50%. And so business meals and business travel is so if you are outside your tax home and you're traveling, so let's say you go to a conference, the mileage that you drove to the conference, the meals that you ate at the conference, the registration for the conference, the hotel, all of that would be part of what is deductible. And so if you ate the meal while you're, let's pretend in Phoenix at the conference, that's deductible, even if you weren't meeting with a client or not, because all of that was for the production of the income. You're learning, you're trying to make your business better. Thanks. Any other questions like that, Donovan?
Does that include alcohol as well, like with the meal?
It does, yeah.
Just wanted to be sure.
Absolutely. Vehicle fuel we'll talk about in just a sec. Thank you, Megan. Any other questions popping up? All right, I'm going to keep going and then we'll circle back if we have more questions about it. Right. So it's kind of in two parts. There's 2 pages to the Schedule C, and then there's the part 2, and then there's a part 5 on the second page. Okay. But so the transactions or the other expenses are right there on line 27. So that's how the detail of part 5 fits into the part 2. Okay. Second. Here we go. All right. So then Schedule C part 3. So I'll briefly talk about cost of goods sold because it doesn't apply to everyone. but it's on the Schedule C, so I thought I would explain it. Usually you're going to just, it'll be at cost, meaning that when you buy it, not what you can sell it for, but what you buy it for, that's how we value our inventory. So think of yourself, maybe you're a restaurant as an example. And so after your first year, you probably have spices and I don't know, bags of flour or things like that, that at December 31st, you still had on the shelf, you hadn't yet sold. And so you kind of take an inventory count of your of the things that are still sitting on the shelf. And again, it's at cost, not what you could sell it for, but what you bought it for. So it's the difference between the inventory at the beginning of the year versus the inventory at the end of the year. And you add everything that you bought in between. And so a common question is if you have to throw away something, there really isn't a place that you record it because it's inherent in this calculation. Because if you threw out a bag of rice or something because bugs got in it or whatever, then it's no longer in your inventory at the end of the year. And that's how it gets recorded. Because remember, when you purchased it, that's part of here on line 36 and 38. That's when you bought it, that's when we record the expense, not when we throw it out. Make sense? Again, not every business has inventory, and then this rolls into, let me just back up. It rolls into that income part, and there's line 4, that summary of cost of goods sold. Any questions? Pause for that.
We did get one in the chat. Is there any limit to the amount for each expense?
No, there's no limit. Just a sense of reasonableness. So, if it's excessive, there may be a reason, or we might need to explore that a little bit, but no, there's no limit. Because you can create a loss with your business if your expenses are more. Now, then you might have to rethink why you're in business because you've worked very hard for free. But hopefully the ladies at SBDC can help you overcome that. All right. All right, that's cost of goods sold and inventory and that sort of thing. So you could record your purchases either here under part 3, or you could also record them in like part 2 type of thing as well. So either way. Okay, vehicle mileage and expenses. So, because the question was vehicle fuel to and from the office. So there's a lot of rules around what we can do for writing off of our vehicle. So on the Schedule C, there is specifically a place where you can, as you can see here in part 4, you disclose the date that your vehicle was placed in service. Oftentimes, if you've been in business for several years, that date is from a couple years ago. And then you disclose the number of miles. So you disclose all your miles and then your business miles. So software like QuickBooks Online, as an example, has that as part of their app where you can easily track it. So the commuting from your home to where you work is not deductible as commuting. However, if your office is in your home, then you can deduct the mileage from your home office to wherever you're working. Okay. So like I used to have a office building, and so me driving from my home to my office building was not deductible. But anything I did after that, so if I went to Staples afterwards, or I went into a lunch with a client, or I went to a conference, all of those miles would be deductible, but not my commuting back and forth unless I have my office in my home. Okay. So first thing. So the mileage rate is pretty generous. It's at 70 cents a mile for 2025. The new mileage rate for 2026 will be issued sometime next month. So I don't know quite what it is, but usually it goes up a smidge because prices for gas and oil changes and all that kind of stuff typically goes up. So it's a fairly good average. You have a choice only when you first place your vehicle in service. So that choice is you can either have the actual expenses, which is gas, oil changes, depreciation on the purchase price of the vehicle. So that's actual versus the mileage rate. Once you place that vehicle in service, you have to stick with the method for the rest of the life of the vehicle because it's an average. And over the lifetime of the vehicle, either method should come out about the same, right? The easiest method is just to use the mileage because it's pretty easy just to keep track of that one thing. But therefore you do not deduct gas as well because it's already included in the mileage. And 70 cents a mile adds up pretty quickly. It's the number one deduction that most people miss or don't do a very good job of. And oftentimes they probably shortchange themselves. It's also the number one thing that the IRS audits because people don't do a good job of keeping track of that. So, especially if you have an app or something or the little booklet in your car, the IRS doesn't care. They just want it documented. And so you are meant to keep a detailed log of the dates and where you went and the miles and things like that. So is there a flat rate we could deduct for mileage or do we have to itemize? So the word itemize actually applies to something else on the tax return. And so the flat rate is this, the 70 cents a mile. And so you simply on the tax return would put the number of miles for business and it would multiply it by 70 cents and then that becomes a deduction on the Schedule C. Did I answer the question okay? So itemized is a different thing, but people kind of mix those words up together. Okay. What about a cell phone? So a lot of times we have a family cell phone and bill. And so we've got the kids on it, and we've got this, and we've got that. So you can deduct a portion of your cell phone bill, even though it's not paid for directly by the business. And that would be one of those expenses that you could deduct in that part too. So you can allocate or just use a percentage of things. Also, internet would be a good example of that as well, right? Because we use them for our business, but we don't use all of it. And I think that that's also one of the guiding lights when it comes to tax deductions. It needs to be reasonable. There's a philosophy of would a reasonable man, woman think that that's correct, or is it excessive? And so if you feel like you could be across from an IRS agent and straight faced and tell them that that's the reason for this expenditure, then it's probably okay. Right? So it's those little details that add up because as we get to the bottom line here, every dollar of legitimate business expense saves you quite a bit on your tax return. All right. Any other questions? Vehicles are usually kind of juicy, so.
Can
I guess
you
there's-
so if it is Alejandra also asked a question, but real quick, can you claim depreciation on your vehicle and these additional deductions, or is it kind of like one or other on that?
It's one or the other. So it's either the actual method, which includes depreciation and gas and oil changes and all the details. And then it's even when you have the actual expense method, it's still prorated or you take a percentage based on the business to personal use. Because let's face it, as a sole proprietor, most of the time we're using our vehicle for something other than just work. We're shuttling our kids to soccer practice and we're picking up groceries and we're going out for a date on Saturday night. All of those personal things, of course, are not deducted. Just the business portion. So even if you use the actual expense method, you're meant to keep a mileage log for at least 12 weeks out of the year to develop that ratio. Is it 90% business use, or is it 50% business use? So that's why, especially for a sole proprietor, just keeping track of the mileage is so much easier. Did I answer the
Makes sense.
question?
Yes, thank you. And then we did get a couple of new ones in the chat. Do you see those?
I do.
Okay.
So how much percentage? So it depends on your life. So and it depends on your business. So again, I invite you to consider what seems reasonable. So if you are a family of four and it's only you and your cell phone that is being used, so like okay, so 25% of the phone bill is just for you. Okay, but you don't use it 100% of the time for work. Maybe you use it 80% of the time. So we just kind of prorate it down a little bit. So it depends on what that percent is. So maybe take 15% of the total bill or 20% of the total bill, whatever feels fair to you. And so taxes and accounting, it's not quite as clear cut as it seems. And so we do rely on what seems reasonable. I have a little saying, pigs get fat and hogs get slaughtered. So don't be a hog. You can be a little piggy at times, but not a big hog. Okay. Can you deduct the full cost of the internet? Again, similar, you probably surf the internet for personal reasons too. So with all things, the IRS would only have to prove 1 mile that was not business use. Okay, that's pretty easy, right? Or one email that was not business use for it to be 100%. So just back it off a smidge, right? Have a little compromise on that.
So does that go, so if you're paying for utilities internet at an office that is dedicated for the business, do you get to deduct those full amounts, or is it still a percentage like it is if you were a home-based business?
Oh, so yeah, so like when I had a separate office,
Mm-hmm.
then yes, for my separate office where I paid rent, sure, you can deduct all of the utilities for that. Because it is business, right? Okay,
Mm-hmm.
yes, you might have emailed somebody, but yeah. Thanks for the question. If it's a home office, that's what I'm talking about more. A home office would be prorated with the internet and the utilities. If you had a separate office that you're paying utilities, then it's completely deductible. Thank you for the question and the clarification. All right, I'm gonna go on. Any others? All right. So here's the punchline. So here's the bottom part of it. Um, so here's where total expenses go on line 28. Then we have expenses for business use of home. And notice there is yet another form 8829. Okay, there's another form. But again, if you're using tax software, it's going to walk you through this and it's not going to be quite so scary. But it is important to just kind of chase it through and make sure because, for example, if your office and home is maybe a little like way bigger than you expect, you might need to look at it a little closer and figure out why the computer, what did you put in there that made the computer think that it's so big, right? So that's why I'm trying to teach you from that angle is so that you can look at your tax return and be a good consumer of the information and know whether it sounds reasonable or not. Of course, you can go to a tax professional, but sometimes they're hard to find and sometimes they're expensive. And so a lot of people like to do it on their own, which was kind of the point of this was to educate you so you could do more of it yourself and or just know what you're looking at if somebody has prepared it for you. So expenses for business use of home, this line 30, there's a simplified method similar to the vehicle. There's two methods. The simplified method is it just simply takes the square footage of your home office. Sometimes that's just kind of a portion of a room. And it multiplies it by $5 per square foot. So that gives you a little bit of an average of the utilities and things like that that you might be using for your home office as an example. So this is just for your home office. You can get more detailed with it. And again, it's on that form 8829 that I won't dig in too far. So we had our income, we had our expenses on line 28. We get to deduct line 29, and then we get to line 31, which would be your total profit. So income minus expenses gives you your profit. That profit as a sole proprietor is taxed two ways, and both of it is on your personal tax return. So first is the income tax. Now the income tax is harder for me to guesstimate with you because it depends on the other household income. Does your spouse also have a job? And then there's also the deductions on the personal side. So as somebody said before, did you itemize or did you take the standard deduction? That's a lot of other conversation. And so we'll just make the assumption that after all that's said and done, that maybe our income tax is at the 10% bracket. Okay. So we'll just make that assumption. Then there's the self-employment tax. So when you work for someone else and you get a W-2, when you look at your pay stub, the employee pays half of the Social Security and Medicare, and the employer pays the other half. And so you'll see that when you work for someone else on your pay stub and on your W-2s. However, when you're self-employed, you get to pay both halves of the Social Security and Medicare, and the both halves together is 15.3%. Now, when you're an employee, you don't get to write off all of those deductions that we just talked about, but that's 15.3% on top of your income tax bracket. So in my example, that's 25.3%. So for every dollar of legitimate business expense, you're saving a quarter in taxes. So in my example, we have $10,000 of profit multiplied by 25.3%. So simple math. So you would owe the IRS for the business $2,530. Okay. And so by keeping up with your bookkeeping, for knowing all throughout the year your income minus expenses, you'll know what your profit is, and you can do that simple math to know approximately how much you need to pay to the IRS, because unlike your W-2 job, there's no money being withheld. You have to do that on your own. I'll also mention, because we're located in Arizona, that Arizona income tax is also another 2.5%. It is now a flat rate of 2.5%. Any questions about how my little calculation happened? Okay. All right, so I'll go to the next page. So the IRS would like their money throughout the year, Arizona as well. And so I just want to talk to you about making estimated tax payments or quarterly payments. Again, things have lots of different names, but essentially means the same thing. So the IRS and Arizona have these due dates. So for the first quarter, which is January through March, the due date for the estimated tax payment is April 15th. The second quarter, which is April through May, it's squirrely and it's a month earlier for June 15th. Third quarter, also kind of a month earlier than you'd expect. And then in the fourth quarter, then it's that following year, January, is when the fourth quarter is due. The reality is just pay it as soon as you can, when you can, because you're prepaying your tax return when you file it later. If you don't make any estimated tax payments and you owe a significant amount, you can be penalized. Now, sometimes those penalties aren't too bad, but it's just something for you to be aware of. It's also helpful for you to pay a little bit as you go so that you can budget a little bit better and perhaps not have a really big bill that you didn't expect. So as a reminder, good bookkeeping, I think I've said that before, big proponent, certainly some tax software and bookkeeping software will help a lot. And it's cheaper than you think. I've heard from a lot of people QuickBooks, for example, they think it's $100 a month. It's not, it's $30 a month. And so sometimes for the price of, I don't know, McDonald's lunch, to make your life a lot easier with the bookkeeping and billing your clients and things like that, it might be worth it. And so you make these estimated tax payments to the IRS at irs.gov/payments, and they will gladly have you make a payment. So in my example, so we owed $2,500. So in theory, you would pay like $700 each quarter so that you would be prepaid for when you file your tax return. Okay. Give or take. And then Arizona, you can do that same math calculation. It would be a lot less, of course, and you can pay aztaxes.gov. They also will be happy to take your money. Since it's a lot less, it's just the income tax portion, not also the Social Security Medicare portion. Like with the IRS, it's a lot less. And so I also want to share with you how you can pay Arizona in a way that might be nice to your heart. So Arizona is very unique in that it allows these Arizona tax credits. And so you may have seen this information around. You can donate to schools. You can donate to, it's called tuition organizations, mostly they're private schools. You can donate to qualifying charitable organizations. For example, food centers. Right now, a lot of people have food insecurity and maybe you want to donate. And if you do donate, just know that that's instead of you paying the state directly, you get to donate to charities you want to donate to, which is an amazing opportunity. It kind of doesn't come out of your pocket, but you get to use your money the way you want. And then finally, there's also another category called qualifying foster care organizations. All of this information is available at AZDOR, Arizona Department of Revenue.gov/tax credits. It's easily Googled as well. So I just wanted to put that out there. Instead of paying those estimated tax payments to the state, you can make these Arizona tax credit donations instead. There are maximums to each one of the categories. So for example, the public schools, if you're single or head of household, you only want to donate like $200. If you're married, you can donate $400. And so that's what it is. So let's say you had $1,000 bill and you're single to the state, you could donate 200 to schools, you could donate some to the qualifying charitable and the rest to foster care if you wanted to, which is a strategy. You can donate for the prior year all the way up until April 15th. So a lot of times people will calculate how much they owe and then make the Arizona tax credit donations instead. So just wanted to offer that, especially as more and more people need help right now. It's a way that you can also help. Okay, let's open it up to questions.
¿Qué era tu pregunta? Gracias, vaya.
Any questions? I can talk about 1099s. I can talk about W-9s.
I was actually just gonna type a 1099 question into the chat. So how do you issue somebody else a 1099, somebody that you've paid more than $600 to through the year?
If you have software, just using QuickBooks as an example, you can do it through the software, and that's the easiest thing. You can, we're just going to get out of to irs.gov. So if you ever go to the IRS, just make sure that you're using irs.gov because otherwise there's a lot of maybe not so good websites. And then 1099 filing. These days we can kind of Google quite a bit, but you can get the forms directly from the IRS. They will mail them to you. You can get them from Staples. You can handwrite them. And then there's also plenty of 1099 filing services. and e-file for biz I've used, and they work great. So there's that. So that's for you to issue the 1099 to someone. Yes, Xero accounting software also does a very good job of 1099s. Correct. Should we talk
Question.
about? Yeah.
Well, before we move on from the deductions, can you, when you're doing your deductions and you have different donations to different organizations, do you summarize that all together, add those all together, or do you deduct it in different places for different donations?
So that's a good question. So I'm just going to repeat that back to make sure I have the question correct. So if you're donating, then does that go in different places on your tax return? And the answer is yes. And so I'm going to, first of all, so the Arizona tax credit donations that I just talked about, that only goes on your Arizona tax return. So it's, again, that math, all of your income, whether it's your W-2 income, your self-employment income, minus some standard deductions, they calculate your tax, and then those Arizona tax credit is applied against the tax, and you don't have to pay it because you've already made the donation that qualifies. If you're donating to something else, like your church or some other approved uh, nonprofit, then that will go potentially on your personal tax return. And those donations are before the tax is calculated. So you're getting a smaller proportion of those donations as a deduction of your business. Or, sorry, as a deduction, not of your business. Extract that. A deduction on your tax return. Okay. So you don't get to deduct any donations that are made through your business. On that Schedule C, there is no place for a line item for donations. But it might be really advertising, right? Like if you're putting your logo on the back of t-shirts for your kids' soccer, that's probably more advertising than donation. Maybe? Because Schedule C does not have a sorry. I've got a ah. All right, hold on. There we go. So Schedule C here in these expenses, there's no place to deduct your donations. And that's very common, and that's a good question. And that's why if it is all in advertising, that may be a better way to classify it. Okay. Alejandra, did I answer your question okay? Can I answer questions about TPT? No, because we are talking about income tax.
Yes, thank you.
Yeah, for sales tax and TPT, we're gonna have to get a door. Working on it. That'll be next. This is gonna be income.
Okay. Let's talk about, okay, let's look and see what a 1099 looks like. Let's see, I'm just kind of Googling them. All right, so here's the form. Now you can't really use this form online because it needs to be mailed into the IRS and it has to be scanned. So really for the price of it, it's so much easier to do it through some software. So this non-employee compensation, so that's where the NEC comes from. You would, if you receive one, then you want to make sure that your income that you're reporting on your Schedule C is higher than all of these 1099s. And then similarly, if you're issuing them, then it's just for the services. So if you buy a product from somebody, you do not need to include that in the 1099. And I'm just going to keep talking. What about a W-9? So if you to issue the 1099, you need to have given somebody a W-9 form. So let me talk about that. Right. So using Megan as an example, so she knows she has to issue a 1099 to somebody who provides services to her. So to get the information to do that, to issue the 1099, she had to request a W-9. And so that's what gets the information. So you fill it out and say, sometimes you need a carrot too. You're like, I'm not going to pay you until I get this back. Thank you very much. This is how we work. And so you can see how that how that flies, but they're going to fill it out. And so let's assume that person is an LLC, but a sole proprietor. It's just them. So they would mark this box, individual sole proprietor. Now, if somebody is an LLC taxed as an S corp, and if you don't know what all that means, that's fine. That doesn't apply to you. Then they would mark this box and put an S here. Right? And so then they can choose whether they're reporting under their Social Security number or their employer ID. So kind of back to the first part of our conversation, why you might want to get an EIN for your business is so that you don't have to provide people with your Social Security number. You kind of got that little bit of protection by just giving them your taxpayer ID. But you still want to protect it the way you do with your Social Security number, right? Any questions about a W-9? There's a bit of confusion sometimes about an LLC. And so that's why I try to clarify it. I'll ask somebody, oh, how are you taxed? They're like, I'm an LLC. I'm like, no, how you're taxed. LLC, remember, is a legal designation. How you're taxed is the tax. And so when you apply for an EIN, you get a letter back right away with your EIN. It tells you how you're taxed, whether you're a sole proprietor, S corp, and so on. All right. So all LLCs born as sole proprietors can become an S corp later simply by filing a piece of paper, a form, and then you choose the different taxation. A little bit beyond this right here, but I am happy to answer any questions you might have in our last few minutes. Okay. Let's see, what else can we talk about? So this is the whole form. So we took it in pieces. All right. Well, I really thank all of you for coming. And I'm thinking there's some latent questions out there.
I
Yes.
will send you an email to ask for an appointment because all these things are so precise to make it.
Your main job as the business owner is just to keep track of your income and expenses. If you do that, then you are great. And then you can get someone to help you with the tax preparation. Yep.
Okay.
Yep. That's perfect. So that's your biggest job is to keep track of your income and expenses. And it also tells you a lot about your business. How are you doing? You have a gut feel for it, but it's different when you see it. And then you can plan ahead when you have current information. So yes, using some sort of method, usually software these days, is the easiest way to go.
Thank you.
You're welcome. Thank you for coming.
I had a quick question about the costs of goods sold.
Yeah.
So just let me know if I'm doing this right. You mentioned something about supplies could be recorded, I think in part 3 or part 2. So what I've been doing is say office supplies I've been recording separately from like supplies that I use to put something together that I is ultimately a good sold. I've been separating those two. Is that correct?
That's perfect. That's perfect. Yep. So what's also important is not just sticking the numbers on a tax return, but it sounds like for you, Donovan, what's also important is you're using this information to run your business. And so that is helpful to know, like office supplies are kind of overhead, right? Whereas the supplies that you use to build your product, that's important to know because you get your income from selling your product. And what is it costing you really to produce the product? That's very helpful information. And so that's where this cost of goods sold calculation comes in. So if you're using some software, make that chart of accounts, make these account names meaningful to you. You don't have to use what's there. You can use your own words to make it useful to you, because doing the tax return is just the thing at the end.
Yeah, thank you.
You bet. All right, we will do our last maybe shameless plugs perhaps of all right, here is the lovely Amanda. There's the QR code. I'll let you take it away.
Thank you. Yes, so if you, so this is us. So if you have additional questions, you can, thank you, Megan. You can check out other events that we have going on. I also threw in a couple of email addresses in the chat too. So if you do have any additional questions, you can email us or LuAnn. I included both of those emails in there. And then and then the earlier one that I threw in there is our website. So you can sign up for our newsletters, see when we're hosting additional events and all of that fun stuff as well. But thank you so very much to all of you for attending. And then LuAnn, your page, so everyone can get that information real quick. So there, yay, LuAnn. And
So
here,
oh, sorry.
go
I'm a
ahead.
little bit different CPA in that I no longer prepared tax returns. I had an office with the whole thing at one point, but what I really enjoy doing is helping people learn how to do their own bookkeeping so that they can run their businesses more efficiently. So that's my niche, and that's what I help people do. So, all right. I think
Thank
we're
you.